Good morning, everybody. Hi, Alan. Evening.
Hi, evening. Morning.
Veronica, you want to start out with what we did last week, and then I'll pick up with Alan about some of the markets and some of the things we see. Go ahead.
Yeah, I'll start what we did this week. This week on Wednesday, we had our webinar where we invited MindRock Capital, which is a venture capital group that works with multifamily offices like us. They're based in San Francisco. And Pavel Cherkashin is quite famous guy who does pre-IPOs through SPVs. And they choose companies that invest in artificial intelligence, blockchain, like self-driving cars, and other science-intensive technical projects. And this week, they presented to Russian investors the opportunities how they can invest in pre-IPO projects as non-Americans, and this is through syndicates, through SPVs, and he talked about the amazing returns that he gets and liquidity. He's, again, really well-known person in San Francisco, and also all the platforms that you see in Russia that promote IPO or pre-IPO are basically using him and his projects and his investments. And we get a lot of requests from our clients and a lot of interest in IPO markets, in Silicon Valley IPO. And I'm gonna give you some statistics because of course the returns are huge and everyone wants to jump on it, but just the market itself, the IPO market or venture-backed unicorns, pre-IPO companies with valuations about 1 billion are piling up. And there are right now about 500 unicorns that are not listed, and which is 2,000. There are just shy of 2,000 companies trading on Nasdaq or New York Stock Exchange with a valuation above 1 billion. So in other words, if all the unicorns are listed today at once, the number of large cap US listed companies would increase by 25%. And most, but not all unicorns are tech companies. And over the past 3 years, there have been a total of 100 tech IPOs. And the current supply of unicorns is equal to 14 years of tech stock IPOs. So the numbers are amazing and everyone wants to take part of it. So to be in that market for investors, it's also important. It's a huge part of the investment world. So investors currently, they have 2 companies that the investors can jump on it. One is Udemy. Udemy is the competitor of Coursera, the online
education.
Courses, online education company, which is right now is booming. Online education is booming. And the other one is Momentus. So those 2 companies, they expect by the end of November, they expect to close the deal. So the investors who are interested right now basically jump in right now.
So there's 2 deals, right? There's Udemy and Momentus, $50,000 minimum tickets, and it's about a 2-year holding period, right? They expect to be, sometimes there's an exit point or in the spring when they can sell off to private equity, but if you have to hold until the thing goes to IPO, which maybe be next February, not this coming February, but then February after that. And then if, then there's a lockup period of after that. Sometimes it can last, holding period can be like up to 2 years, but between 6 months and 2 years, I think is what he said, right?
Yeah. Yeah, correct. They recommend about 2 years.
Excellent. All right. So let's talk about the markets now. At least you want to bring us up to date with what's going on in the UK?
Yeah, I thought I would start with the UK and the ongoing Brexit saga, which is changing kind of day by day right now. But the facts or the situation as we know it, there was big headlines in the last 24 hours where Prime Minister Johnson basically made an announcement for British companies to prepare for a no-deal Brexit. Because there's a deadline of the end of this month when a deal needs to be done, basically to make sure that there's anything that needs to be put in place before the end of the year, which is when the transition agreement ends, there's enough scope and enough time for that to be done. So we're getting really to the 11th hour now, and I believe, might be proved wrong, but I believe that this is still a negotiation tactic from the current UK government to try to push for the best deal they can. They'll wait until the last possible moment to sign any kind of agreement, because they know that the EU works on a compromise basis, and as they are working on their own, they can kind of push for that. I think much easier than a collegiate agreement, which would be the EU position. So the pound fell heavily today. Based on those comments, and our thoughts are as follows: that basically now is a bad time to sell. So if you're in, and you should stay in. But actually, I believe that it's possibly a good time to buy UK stocks or even to buy UK pounds, just because I think a lot of the bad news for Brexit is already in. And on the basis that there will be a deal, either the transition agreement will be extended, which would be a politically unpopular move, but economically an acceptable move for British businesses, or there will be a deal at the 11th hour, which will generally be good news for the economy and for the pound. I think there's a strong possibility of a bounce back on both of those assets. So the pound is not in a bullish pattern. I think it's a very negative pattern, but I think that there's information that will come out that a lot of the bad news is already in, and I think it's going to be a positive for both. And I thought there was a couple of negative graphs that we could bring up. This one is US sales of heavy trucks, and basically how they fall. And if you see the last tick, so there's obviously a big fall off at the beginning of this year when the pandemic lockdown was enacted. Then there was a strong rebound over the summer, or this end of the second quarter into the summer, and then you'll see it starting to trend down again. And that's the worrying bit. If that's not arrested and it ticks back up again, then we could be seeing the recession coming. Shocks versus surprises is, again, they're kind of coming back to more shocks rather than surprises. Surprises are positive, shocks are negative, and you can see that that's kind of coming off its highs, albeit a pretty big high for the last year. But it's trending back down, and if, again, that's similar to the trucks, if that doesn't get arrested and start to kind of stabilize a little bit, then we could be into a bit of a problem. Chris, we discussed earlier about the election is coming soon. A lot of our clients are ready to get back into the market from cash positions, and that's based on the growing expectation that Biden is going to win. There was, I think, a poll done this week that showed a 17% or 17-point lead for Biden. Whether that turns out to be accurate or not, and can he hold that kind of percentage as he goes into the final month and the final few weeks of campaigning, that remains to be seen. There's also something that we thought maybe was worth discussing this week, or worth mentioning, is that sell on buy on the rumor and sell on the fact. So the markets will recover on the expectation that Biden's going to win, and then once he's confirmed as a winner, the markets will kind of fall flat again. I think you were saying, Chris, that the indicators for our seasonality, at least, are not quite strong enough to get back into the market yet. That's what we're reading.
Well, the thing is, in September we had a pullback, and then at the end of September, 25th, I think, of September, the market started going up again. And
Chris, we had a pullback in September, but it was mainly a Nasdaq pullback. Was there a big pullback on non-Nasdaq, non-FANG stocks, or was it just because we've talked in the past about a broad market recovery and a broad market drawdown? But was it, we've seen huge increases in IWM, which is what you're showing right now.
But so in September until that like 25th of September, the IWM was down, say 10%. That's enough to call that a correction, right?
Correction, right. And that was similar to the Nasdaq. That was also down about 10, 12.
Yeah. So the Nasdaq also was down. That was down somewhere around 14 or 15%. So that, that's enough of a correction. And the problem is the rebound happened in late September. Do we call that the rebound for the season? Well, the market's grown so fast so far that people are concerned now that there's a chance for a second bottom here, or a second retest of this. And I think, that's where we're waiting for a better signal at the end of October or sometime in November, even maybe after the election, that look, things will be clearer in terms of the fiscal stimulus, if it's going to happen, what kind of stimulus package is going to happen. But just looking at our calendar of what's on our website, you see that the things to be long in the end of October are utilities, which is a conservative or a position that to save your money. And you're short basically materials, short industrial, short transports, and short semiconductors, which are the things that would show that the economy is actually ready to go ahead and rebuild and take off strongly. So we're waiting for those signals. The signals aren't here yet. You'll see, and we can go through all the little indicators inside the market, but you see the MACD on the NIMO is turning over. We've covered these many, many times. So these things here are not so positive right now. We're waiting for some kind of a pullback, maybe in the last 2 weeks of October, depending on how far we get in that pullback. McMillan mentioned today that there's a sell signal on the S&P. There's a sell signal now on the Nasdaq, and those can come back and maybe go down maybe 100, 200 points on the S&P, which is quite, not a substantial pullback, but a 5%, 4%, 5% pullback would be something that would reset the market. And so that's what we're looking for. And I think I just wanted to show, there's a couple more slides I thought were interesting, that you see an enormous amount of, again, options on the Qs. In other words, the Nasdaq. You got a lot.
This was pretty scary, because that's the biggest.
Yeah, you got a lot of people
since the dot-com bubble, basically.
Hedging again. Maybe they're short and they're hedging long positions, or they're long and they're hedging short positions. And you get a lot of whiplash, like we had on Wednesday this week, where the market's down 2%, and then you wonder if it's going to have any follow-through, and it doesn't. And so you get these extremely volatile intraday trades because of the amount of options being played on the indexes right now. And you also have, which I think is a kind of something we have to keep in mind. Again, this shows that a lot of the option players are what they call short gamma. In other words, they don't want the markets to move. They're trying to hedge all their positions, which in itself exacerbates the market, and the fact that everything is highly correlated. Correlated now, we haven't seen since maybe back in 2011. So in the last 9 years, we haven't seen this level of correlation between all assets, including bonds, real estate, utilities, and
commodities.
Commodities and all kinds of stuff that are usually used for diversification in portfolios. So I think a good place to be right now is still a large, position in cash or in bonds until we get a conservative investments, until we get a more clear signal. And those people that follow the seasonality stuff are still on hold here. So that's what I've got, and I think that's enough for this week. We've talked a lot about the good stuff that's happening. Vron's going to be traveling to Russia next week, and hopefully that goes well, because the whole situation over there is pretty scary with coronavirus and stuff. So we bid farewell to her this week, and we'll be touched next week on Friday. And have a good weekend, everybody. Yeah.
Yeah.
Okay.
Good weekend, guys.
Take care. Yeah.